If you own an LLC and you're just transferring money from your business account to your personal account whenever you need it, that's going to eventually hurt you financially and during tax time. The problem isn't that what you're doing is illegal. The problem is most LLC owners don't know what those transfers actually mean, so they don't have a peace of mind when they're trying to move their profits back into their personal accounts. So in this video, I'm going to show you how to pay yourself as a business owner in 2026 to not fall into any traps and common mistakes that people make. This video is about clarity, control, and avoiding any surprises, especially your year-end tax bill. Now that you're self-employed and your business is making money, controlling that cash flow of money coming in and money going out is pivotal. So let's first talk about what most LLC owners do that is the biggest mistake. So everyone has money coming in, they have some revenue, they have money going out, they have expenses, and when they say, hey, I need some money, I'm just gonna, transfer some to my personal account. There's no structure, there's no system, they're just kind of commingling personal and business at the end of the day. And to be clear, this is where problems begin, because you start to use credit cards the wrong way, you start to account for things the wrong way. When you start to upload transactions into QuickBooks, it's going to be a big giant mess. You don't know what's what. So let's talk about the right way to do all this. Owner's draw. This is the fancy term of saying, I'm going to draw profits as an owner and pay myself. Owner's draw, also known as owner's distribution. This is the primary way you're going to pay yourself if you're a sole proprietor and you just open up an LLC that you're going to have your business under. Keep in mind, this is not payroll, this is not salary, and this is not an expense on the business. So when you hear owner's draw, think about you're moving money from your business bank account to your personal bank account. So the most important rule is separation of your money. So in order to successfully do an owner's draw, let's talk about the 3 steps. Step 1, you're gonna open up an EIN. It's called an employer identification number. Think of an EIN as like a driver's license for your business. It just is a way to document for the IRS that this entity actually exists. In the video notes below, you could click the link and that's where you go to open up an EIN once you have already opened up your LLC. In order to get your EIN, you're gonna need to provide information about your business, like the business name, address, your contact information. And once you have this EIN, this is what's gonna go onto tax forms as well. And lastly, this EIN is going to be used to open up a business bank account. Now that you have the EIN, you go to a bank, say Chase or Bank of America, and you say, I want to open up a business bank account. The bank is going to ask you for your EIN, your business information, some company documents, and then they're going to open up that business bank account for you. This is where it all begins. Now, every dollar that comes into your business and leaves your business is going to go through this business bank account. This is where all your LLC's money is going to live until you decide to transfer it out or move it to someplace else, like your personal account. Now, side note, something to keep in mind, everything related to your personal money and everything related to your business money needs to be separated. Not only will this be a peace of mind for you, but this is going to make your business far more attractive once you try to sell it in the future, because it's going to show only your business performance. So always remember, business bank account, personal bank account, separate. Not only will you have messy books, but come tax time, information will be incorrect. You may overpay taxes that you shouldn't be. Also, there's going to become a lot of legal confusion down the road. So let's talk about how to actually pay yourself now. Let's use an example. Let's say in December, you made $10,000. $10,000 came in, you paid your expenses, you took care of what you needed to, and now you have $5,000 left in your business bank account. You put half of that away for taxes and you have $2,500 left that you say, hey, I want to keep to myself and transfer to my personal account. You then use a bank transfer or a check and pay yourself and transfer that money from your business bank account to your personal bank account. This is completely legal. This is the way to do it, super clean. Keep the records of it and always know why this money came out of your business so that down the road, you understand where your equity lies, how much you have of equity in your business. And that's it. Once the money's in your personal account, you can do anything you want with it. A big advantage of this structure is you don't need to run payroll. You don't need to pay yourself bi-weekly. You don't need to have a salary. You could just freely pay yourself whenever you feel like it out of your business bank account. You could take out less in the slower months of your business, and you could take out more in the bigger months of your business. It's all about how disciplined you are. So this is where LLC owners get burned, and it's because everyone gets the excitement of, hey, I'm turning a profit. Now that money belongs to me. I want to do whatever I want with that money. Keep in mind, an LLC is taxed as a sole proprietor. That means they get taxed on the personal income tax level and self-employment taxes. Self-employment tax is around 15.3%, give or take. And the IRS does not care if you leave the money in your bank account or you transfer it or what you do with it. As long as you turn the profit that year, Uncle Sam wants his cut, and you're going to owe that percentage of taxes based off of how much you made. So don't think, hey, if I just leave the money in my business bank account, well, I'm not gonna have to pay taxes. That's not true. Be prepared to pay at the end of the year. So let's give an example about setting money aside for taxes for the end of the year. Let's say your LLC made $150,000 in 2026. Of that money, you netted $100,000. Now throughout the year, you said, hey, I wanna pay myself. So each month you $10,000, $8,000, and that $100,000 came all out of your business account. You sent it to yourself, you used it for personal reasons, and now you don't really have any money left from your business. Suddenly the tens and thousands of dollars that was there is no longer there. So this is why people say, hey, I made a lot of money, but I feel broke. It's a structure problem. Now, once the year is wrapped up and you owe taxes next year, you don't have the cash sitting idle waiting to pay that tax bill. This is going to leave you scrambling, running around, hey, where do I get the money to pay this? I'm gonna owe $30,000, $40,000, I'm stuck here. And this is why structure is so important. A simple way to fix this is setting aside some of your net income each month and not distributing that out of your business. Usually the rule of thumb is around 25 to 35% of what you netted. Is it perfect? No. Is it better than guessing? Absolutely, and you're gonna be in a far better position come next year tax time. Now, I know you've heard the terms S Corp and C Corp and this Corp and that Corp, and you don't really know, well, when does it make sense to not be an LLC anymore and to maybe switch to something a little bit more advanced? As your business grows, an LLC taxed as a sole proprietor starts to be disadvantageous to you in the long run because you're going to pay so much more in taxes. Here are 3 indicators to think about as to when it's time to switch to an S Corp. 1, your profits start to become consistent. 2, self-employment tax starts to hurt. You're paying way more than you need to in self-employment taxes. 3, structure becomes important and you're making over, let's say, $80,000, $100,000 in your business. This is a general rule of thumb. Maybe it's time to switch to an S Corp. Keep in mind, once you do switch to an S Corp, there are some more things you're going to need to do for maintenance and paying yourself salary and filing taxes at the end of the year. There are some more costs associated with it. So you want to be absolutely certain that it is time to make that switch. A CPA could help you with that. I could help you with that. And one last thing, an LLC is just about structure. It's just about limited liability for your assets. It has nothing to do with tax and saving on taxes. So to close it out, keep in mind, guys, it's all about setting the right foundation when you get into business. You don't want to be caught off guard by stuff like you owe taxes or your books and records are a complete mess. You don't know how much you made last year. It's all about control and being able to pull the different levers so that you eventually reduce your taxes, keep the most amount of money, and understand how your business is performing. If you want to understand when an S Corp exactly is meant for you, I'm going to break that down in another video. And if this helped, please drop a comment. I'm going to answer every single one of them. Appreciate you guys as always, and I'll see you in the next video.